corporate credit spreads, they still suggest little to no stress in the bond market, except we have had two significant failures, which are changing the tone in the private credit markets and the least liquid expression of junk debt. If you want to think about the private credit markets, it is junk. It is very high yield. It's even higher yield than what you would find in the junk bond market, in the high yield market. So lower quality, less liquidity, and that's where we're beginning to see at least a couple of cockroaches. So First Brand's failure and then Tricolor's failure a few weeks ago continues to raise concerns in the structured finance market. If these concerns are not ameliorated in short order, it's reasonable to assume bond market stress is next, high yield, and then ultimately investment grade debt. If you look at the Bloomberg Leveraged Loan Index, it registered its first loss since April, with the default rate quadrupling over the past 2 years, according to Bloomberg.
That's the part that most people don't see, is the default rate until it hits them.
Well, and again, you're talking about the leveraged loan index. Who's invested in leveraged loans? These are institutions, these are insurance companies, these are pension funds.
Right.
This is not something that someone goes on to CNBC and says, I wonder how the leveraged loan market is doing today.
Right.
I wonder how the CLO market is doing today.
Well, you don't necessarily sell a leveraged loan to somebody. It basically gets placed into a captive audience, like you said, an insurance company.
Yeah. Now, interestingly, there are some new ETF products that allow you to buy highly illiquid CLOs and leveraged loan products. It's becoming popular, right? But that's what happens at the end of a cycle. I remember talking to one of our friends on the East Coast many years ago. This was sort of 2008, 2009. He was very excited about the reduction in barrier to entry to hedge funds. Instead of it being $1 million,
now you can play
with $50,000.
Yeah.
And democratizing access to financial products suggests that the best days are already behind you, and the folks on Wall Street now need new players,
new bag holders.
Exactly. You got to keep the game going. You got to keep volumes flowing. And so the little guy does end up being the bag holder. One of your first indications that that's coming is products accessible to the general public, never before accessible. It's a democratization of access. And I mean, you can hear from the White House, they're talking about giving access to 401ks where you can own private credit in your 401k.
Put the bag that nobody wants to hold in your 401k. But you talked about it. It first starts with junk bonds and then it moves to regular investment grade, doesn't it?
There is a notable tone change in the leveraged loan and the collateralized loan obligation space, with unexpected corporate failures becoming more expected.
Right.
It's happening more regularly, and portfolio managers are selling distressed debtor paper in response to credit downgrades, and it's happening fairly routinely in the last 3 to 6 weeks. This is the periphery of the credit markets, and where you'd expect to find the problems. No one should treat them as surprises. I mean, last week it was the second in a row of outflows from U.S. junk bond mutual funds. So there are growing concerns even amongst the hoi polloi, if you will.
Right.
A change in tone and now a change in flows. I think this is worth thinking about. A change in tone and now a change in flows. ETFs, I mentioned ETFs for collateralized loan obligations, CLOs, also saw outflows last week. The issue with those structures is in the implied liquidity provided by an ETF. How easy is it to sell? Go online, click the mouse, you're done.
Right.
But the underlying assets are not that liquid. So where do they go? Who is the next buyer? Who makes a market in private credit, in CLOs? Weekly inflows into CLO ETFs, they've averaged, this is the inflows, they've averaged 421 million year to date. That's the weekly inflows. Last week was a $516 million outflow.
That would be considered a reversal. So last week you talked about the
change
IMF.
in tone, change in flows, worth keeping in mind. The credit markets at the periphery are beginning to show a little stress.
Well, and you brought it up last week because the shadow banking, okay, now there's a fancy name for that. It's non-bank financial institutions.
NBFIs.
There you go. But it's shadow banking.
It's shadow banking. Yeah. So we highlighted the IMF's review of financial market concerns, including the crossover of liabilities between commercial banks and the NBFIs last week. You've got U.S. and European commercial banks, combined U.S. and European, with an estimated $4.5 trillion exposure. That's with a T,
right,
to shadow banks, which far exceeds what Reuters has documented as a $300 billion exposure in U.S. bank loans to private credit providers. So there's
$4.5 trillion.
Again,
wow.
part of what the IMF paper was getting at is we don't have our arms around how big this is. Is it what Reuters reports, a $300 billion exposure? Is it, when you look at the U.S. and European market combined, $2.5 trillion $4.5 trillion exposure? There's a big gap between $300 billion and $4.5 trillion.
Well, we compared it to an iceberg last week, okay? And I know that can be a tired metaphor, but, $300 billion would be the top. Everything underneath that $4.5 trillion would be $4.2 trillion, right? Would be underneath.
Yeah, well, Reuters calculates the percentage of total bank loans to the non-bank financial institutions currently at 10.4% of their entire loan book. So it's not an insignificant percentage, and that's up from 3.6% a decade ago. This has been the largest area of loan growth in U.S. commercial banks since 2016. Every year since 2016, that's where they've been making loans. It's basically, we can't go to the general public, but we can keep a tranche of risk on our balance sheet and then through these sort of structured products, move them on, but still participate. So the jitters are entering the conference and the boardrooms following First Brands. That's the auto parts manufacturer that went bankrupt, and Tricolor, which is a subprime auto lender. They declared bankruptcy out of the blue.
So I want to bring something up that I remember, Dave, when we were doing the commentary back during the global financial crisis, going all the way back to 2008, 2009. Moody's and Standard & Poor's, the rating services, were giving everybody high marks as they went on to fail. And it was like, that was, there was a mea culpa there where it's like, what's going on?
Well, and essentially what they were doing is this slicing and dicing of financial products.
Right.
And if you can create tranches of risk, you can take one and say, well, this is AAA over here because it's very limited in its risk and we've carved it out from the rest. This other stuff may be just absolute toxic waste, but it's not a part of this product. Now, they are connected because the underlying assets...
Pay no attention to the other part of the asset behind the curtain.
Right. But in a very similar fashion, if you look at real estate law, you can have any bundle of sticks. And when you own real estate, do you own one or do you own all of the sticks? Do you own the water rights? That's one stick. Do you own the surface rights? Do you own the mineral rights? You may own a piece, but not the whole. And that's what they've deliberately done to a particular asset class. When they go through this sort of structured financial process, they're slicing and dicing. That's the IMF concern. So not unique to an end-of-cycle dynamic is the accounting and audit work done for these firms and these particular products, which is there to sort of confirm legitimacy and the viability of the books. And this happened just weeks before the failure of both First Brands and Tricolor. BDO, unfortunate, BDO signed off on First Brands financials weeks before several $1 billion simply vanished. And the reason why I say this is end of cycle, that's the best way to frame it, is because the tide reverses and the naked swimmers are revealed.
Yeah.
Tide goes out and there you are in your birthday suit.
But this goes back to the IMF report. I mean, it's not just the IMF right now that has been saying there's a problem here. The Bank of International Settlements has also been screaming.
Yeah, in a 3-week period, you've got the IMF, the BIS, and the Bank of England all raising concerns over private credit and the slicing and dicing of risk tranches.
Right.
And as we've said before, bodies are buried in many of your insurance company portfolios. Like a moth to the flame, for years now, insurance companies have gravitated to higher yielding paper.
Well, haven't they had to? I mean, we went through that period of time where we were zero interest rates. How did an insurance company continue to pay?
Right. A part of it does relate to being in a zero interest rate environment and searching for better alternatives. You've got to match up your future liabilities with an income stream. And in the zero interest rate environment, it forces you to take more risk, but you're not really concerned about it because you can hold those assets to maturity.
Right.
So regardless of the ups and downs of market volatility, you don't have to mark them to market. And so you are in this unique carved out space.
As long as they don't default.
Well, that's right. And because insurance companies don't have the equivalent of depositors, the captive asset portfolios at insurance companies have been prime targets for private equity and private credit. Right. So this is again where these groups get to dump their trash. And the intent of these insurance companies is to continue to add to private market holdings. The effort is to smooth long-term returns. They don't want to see the volatility in the stock market and the bond market, so they have these structured products which have, the guaranteed rate of double-digit returns, and you can take on a little bit more illiquidity because, again, you don't have a depositor base that's going to come knocking and say, I want my money back, like you would at a bank. Right? So in a BlackRock survey of 463 insurance company executives, 93% expect to increase their exposure to private equity and private credit. Only 3% said that they were considering reducing their exposure. Insurance companies already hold $2.5 trillion in private credit assets, $250 billion in CLOs. If you want to know where the next major bailout will have to be, look at insurance companies. Look at the annuity powerhouses. When I say that's where the bodies are buried, we're talking about mass graves. Regulatory arbitrage, that's the game. You can do inside insurance companies what is impermissible in more scrutinized and regulated markets.
Well, and up to this point, insurance companies typically bail each other out, but this could be larger than that, right?
Well, and insurance companies are quickly becoming a version of shadow banks. You can't. This is what will come as a surprise to the markets. It's a black swan event. I can't believe this insurance company went under. You can't claim this as a black swan event. This setup was laid out. The Federal Reserve was writing about the risks of insurance companies becoming shadow banks as far back as 2023. This is not a news flash. It just takes time for rot to sort of fester.
I wonder, because one of the things that the insurance companies have avoided is a lot of government regulation because they self-regulate. They bail themselves out. And it's worked. I mean, even look at the Depression. The insurance companies came through the Depression because they saved each other. But right now, for competitive reasons, like you said, it's becoming a shadow banking system on its own.
I think it's also that you have individual state regulators for insurance companies.
Right.
So what is the law of the land in California may not be the law of the land in Nebraska, Idaho, or Florida. And so it allows for a dance to take place. Again, that's the regulatory arbitrage that private equity and private credit are taking advantage of in order to be able to place their wares into these portfolios and then to walk away. Well, not just walk away, because frankly, some of the private equity groups have bought insurance companies specifically to be able to feed their products continually, capture that, captive asset, and just they've got a place. Do you need to raise money? No, I bought an insurance company.
Relationship, isn't it? Yeah, just feed it on out. It's the trash pile.
Axios describes institutional investors this way. And again, this is all sort of in the wake of these two company failures. And you might not have even heard of these two company failures, but the ripple effects into the credit markets, it's creating some consternation around boardroom tables. And asset allocation committees are having to say, we need to get our arms around the risks that we have in the portfolio. And Axios said there is a rush to risk discovery. And again, following the blowups of First Brands and Tricolor, there is a question on the table. And it's amazing to ask this question after after, keep this in mind, the sequence, after engaging in complex and illiquid assets. What do we own?
After these guys got good ratings right before they failed. I mean, the rating industry is basically saying, hey, you guys are fine.
So what do we own, and what is our downside risk from here? Add to that the professional asset allocator that takes on any accounting firm's word for legitimate financials, right? Only to discover a clean bill of health from an auditor is worthless. It's the equivalent of financial and accounting malpractice.
Right. Well, and we saw that during the global financial crisis.
And even before that, Enron was the end of Arthur Andersen. And I think this is really the critical piece here. Trust breaking down is a really important social signal that you are at the end of a cycle.